Hello, I'm Elaine Sanchez, founder of Caregiver Help, and with me today is Brenna Baucum, a certified financial planning professional, and this is our continuing series of Life After Caregiving Going Solo. And we've been talking about some of the financial challenges and realities that people have to face when a spouse dies or any loved one for whom they have a financial connection. It could be a parent, it could be an aunt or an uncle or a sibling. There are all sorts of people that end up managing other people's affairs at the end of their lives. But what we're going to be talking about in this session is about investments and what changes and what doesn't. So whether we are looking at growth or income or long-term stability or short-term splurges, it's really good to have a certified financial planner in your corner to kind of help you make sense of this so that you can make responsible decisions about how you invest your money and about how you have freedom to spend it or the need to conserve it. So, Brenna, with that, it's kind of a complicated introduction, but I know you know how to make sense of this.
Yeah.
So welcome back.
Thank you. Thank you. Yeah, investments I think can feel scary to a lot of people.
Yes.
We talked at the one of our very first sessions about how typically there's a household CFO, someone who
Yes.
manages the finances, and someone else who
Yes.
does other tasks, and that is completely normal in terms of a division of labor.
Mhm.
And if your caregiving meant that your investment picture changed when the person you were caregiving for passed away, whether it was your spouse, whether it was a parent, and now you have an inheritance to manage. I
Mhm.
think getting our arms around our investments, understanding where they are, what their role is in our life and in our new
Mhm.
reality moving
Mhm.
forward, very, very valuable, very, very valuable use of your time for sure.
Yes. So what if when you look at the people you work with, um, are there things that typically stay the same and are
Mm,
there things that typically need to be changed? And how do you know? I mean, when you look
yeah.
at it, how do you know whether you just stay the course or whether you make a big adjustment?
Yeah, I mean, the two kind of big drivers of what to do with your investments are your personal risk tolerance. Like how
Mm-hmm.
comfortable are you with seeing your portfolio do this?
Mm-hmm.
Or maybe you like it more like this,
Mm-hmm.
or maybe just like this,
Yes.
versus your time horizon. When do we need the money? So
Right.
those two things together help to inform general investment strategy, and of course, time horizon is very closely attached to goals and what we think the money is going to be used for. So, in a lot of cases, I see clients who have different buckets for different needs.
Oh, sure.
So, you have kind of short term needs, which are
Mm-hmm.
invested pretty conservatively or in cash.
Mm-hmm.
Midterm, little bit of growth in there, so it's keeping up with
Mm-hmm.
inflation, but not fully exposed to the market.
Mm-hmm.
And long term money, which can be more aggressive.
Mm-hmm.
So that long-term money might be for long-term care expenses. It might be for an inheritance you hope to leave to your loved ones when
Mm-hmm.
you pass.
Mm-hmm.
All sorts of different definitions there. So sometimes the plans that we had in place before our loved one passed, usually our plans moving forward are pretty different. So a very good time to come in and say what is appropriate. I've had some cases where clients have said, I don't, it's just me now.
Mm-hmm.
My income has changed and I
Mm-hmm.
just want to move everything to cash. And
Oh.
so that is a valid feeling. And when we actually start to look at what that means long term, usually people change their tune.
Mm-hmm.
So I've never met someone who wants to take more risk than they need to in investments. And
Mm-hmm.
that's the other key to this is talking about risk tolerance, talking about time horizon, but also how much risk do we need to take
Mm-hmm.
to be able to keep up with inflation, to be able
Mm-hmm.
to, and we talked about this in another video, the inflation of your groceries, very different than the inflation of
Right.
healthcare expenses. So again, thinking through what, from a time horizon perspective, what do we need? And do we
Mm-hmm.
need growth? Do we need income to support our lives now? All of those drive those investment decisions
Mm-hmm.
and comes back to the financial plan itself.
Mm-hmm. Mm-hmm. Mm-hmm.
So it's very different for everybody. There is some rule of thumb out there, and I think it's take your age minus 100, and that's how much you should have in fixed income. So the typical investment portfolio has bonds or fixed income
Mm-hmm.
and stocks or equities.
Okay.
Stocks or equities are the things that help raise up your return. Fixed income is the stuff that keeps it steady. It still
Okay.
grows, but keeps it steady. So if you are 20 years old, maybe
Okay.
you have 20% of your portfolio in fixed income and 80% exposed to the stock market because you have a lot of time before
Oh,
you need this money.
interesting. Okay.
Whereas if you're 70 years old,
Okay.
maybe you have 70% in fixed income and 30% in equities because you don't
Okay.
have as much time and you want
To
more
recover.
stability.
Uh-huh.
Yeah, to recover if something
Uh-huh.
goes sideways.
Uh-huh.
Exactly. So that's one rule of thumb that I can be kind of helpful as a general concept, but
Mm-hmm.
I never met a client who just fits perfectly into that mold,
No,
right?
no, no.
Because, and different buckets need to do different things. So when we think through actual investment strategy for one person, it's much more unique than a rule of thumb like that.
So can you explain to us annuities, how
Mhm.
annuities work? So that would be your fixed bucket, right?
That is a type of fixed bucket. So
Okay.
essentially, with an annuity, what you're doing is you give a certain chunk of money to an
Mm-hmm.
insurance company,
Mm-hmm.
and you say, insurance company, I don't want to manage the risks of being an investor in the market on my own. I want to
Mm-hmm.
give it to you, and I want guaranteed income from this, regardless of what happens in the markets. So sometimes people will say, okay, here's $100,000. It is an insurance product. So it's not,
Didn't know
should
that.
be
Okay.
viewed that way.
Uh-huh.
So an annuity has an investment like behavior to it, but
Okay.
it's technically an insurance product. And again, one of those products that sometimes gets sold inappropriately because of a
Yes.
commission. So
Yeah.
just be careful when you're thinking about an annuity because they can be kind of hard to get out of. So
That's what
that
I've understood. Yes.
yeah, so you're basically transferring that risk, and in exchange, the insurance company says, "Sure, we will pay you $1,000 a month now through
Mm-hmm.
the rest of your life. We're going to be, insurance company, going to be investing what you gave us into the
Mm-hmm.
market.
Mm-hmm.
And for you, you have a floor and a cap on what you get to experience from that investment.
Okay.
Meaning, if the portfolio does 20% in any given year, your ability to retain any of that is capped at 8%.
Okay.
And in exchange, if the return is negative 20% for the year, your floor is zero, can't go below zero. So that's the protection part
Okay.
for people who buy that insurance policy. But the cap on the other end is usually 6, 8%.
Okay.
So it's important to think through the trade-offs that you're, and that's true anytime. Anytime
Yeah.
you're getting some guarantee is kind of a word you want to proceed with caution when it comes to the financial planning industry. Anybody
Yes.
tells you guarantee, that should be a little yellow flag to investigate further. But that's how insurance companies do it. That's how they make money. And that's how they're able to guarantee those payments over time because in the years where it's above your cap, they're retaining that profit to be able to guarantee payments when the years when it's below that cap.
So then when a person dies,
Mhm.
what happens to the remainder of the money that went into the annuity?
So typically you can assign a beneficiary designation to
Okay.
it, just like you can others.
Mm-hmm.
And that entire amount goes to that beneficiary with the
Mm-hmm.
same tax consequences that you had.
Mm-hmm.
There's
Mm-hmm.
different ways to fund them, but generally speaking, that's true. So,
Mm-hmm.
and that can be a benefit and a drawback from a tax perspective
Mm-hmm.
for the inheritor. If there's only a little bit of money in there and
Gotcha.
there's a big tax difference.
Okay, so if we have fixed, right,
Mhm.
or not fixed, and then we have the growth.
Hmm.
So explain the difference between those,
Sure.
that investment strategy.
Yeah. So fixed income, also known as bonds, it wouldn't be, I mean, the financial industry just has a million words for the same thing, I
Sure,
think, just to make it sound complicated.
sure.
But, and that, yeah, bonds from, which can be corporate bonds for
Mhm,
companies, could be government bonds.
mhm, mhm,
It can include all sorts of things, but essentially it's a loan that you're giving to this company or the
mhm,
government, and they're
mhm,
paying you back that loan with interest.
mhm,
So that's a little more stable in
mhm,
that investment versus stocks or equities,
mhm,
where you're actually buying ownership in
mhm,
that company
mhm,
and saying, I really want a piece of the pie. I want a piece of your profits.
mhm.
And, Apple is a great example. You might
Right,
buy it at $10 a share, and now it's much more than $100 a share, but we'll say $100 a share for easy.
right,
That $90 difference in there is that's the return you get to enjoy
right,
as an
right,
investor. But also, Apple hasn't always been doing well, right? It also has its ups and downs. So there's
right.
much more volatility on that equity side than there is on the fixed income or bond
Mhm,
side.
mhm. So then when you meet with clients, then you assess what is your risk tolerance?
Hmm.
How comfortable are you with swings in the market?
Yep.
How much do you want to protect the equity, right?
Yeah.
So talk about that just a little bit more.
Sure. So risk tolerance, the funny thing about risk tolerance is that we're asking you in a state of calm. The conversations I'm having with people
Yes,
is
yes.
what would you do if the markets dropped 20%? And almost everyone says, I wouldn't do anything. I wouldn't, make any changes. And then we have a year like 2008 and everyone's gripping
You're
their
on the
chest and
phone.
calling and yeah, and that is normal.
Yes.
So oftentimes I ask, what would you do? But also, what did you do?
Mm-hmm.
Like, how did you react in
Mm-hmm.
2008 or in 2020 when the markets went down for about a week and a half
Mm-hmm.
and then came bouncing, roaring back? Because that's
Mm-hmm.
the tricky part is it always feels very obvious when
Mm-hmm.
to get out.
Mm-hmm.
It is not obvious when to get back in.
Right.
So most often it's when people miss out on this recovery that can be the
Right.
most detrimental to their long-term plan.
Yes.
And if you layer that on top of going through transition, going through grief, of course you want stability, right? And
Yes.
and, and a market pullback might feel really uncomfortable, but boy, hold strong. That's always the thing. And making sure that before that happens, we are adjusting the portfolio and it's in alignment with what you need as much as possible. And making sure, okay, yes, the markets are pulling back, but the money you need for the next 18 months is in cash. We don't have to worry. We have
Yeah.
time to ride
Yeah.
this out.
Yeah.
That's
Yeah.
the kind of
Yeah.
thing we try to do proactively.
Yes. And it has provided me personally and Alex with a lot of, I would say, confidence and comfort. And I have learned to trust that that you know what's happening, you're paying attention, you have advisors that you listen to.
Hmm.
And so I don't have to try to second guess what's going to happen because it's, for one thing, it makes me crazy.
Yeah.
If you listen to everything and if you read everything and you aren't an expert in this, you can make some really bad decisions.
Yeah.
Yeah.
And
So,
with the internet and the way the news
mhm,
cycle works, you can find a
mhm.
story on just about anything that you would want to
Yes,
find. And to affirm any belief or
yes,
disprove any belief.
yes,
So
yes,
it is harder now, I think, to stay a steady investor than it used to be.
yeah,
But that is where partnership does come in really handy.
yeah. So how do you, as a professional, as a certified financial planner, where do you get your information? How do
Yeah.
you know? How do you keep up with this?
Sure. So, like you said, I have an investment team
Uh-huh.
that helps with our portfolio and design, and most advisors are going to have a team of their own that's
Mm-hmm.
leading some of their decisions. From a consumer perspective, I really like Yahoo Finance for a news outlet.
Okay.
I wish it was CNBC or something like or CNN or maybe something that feels a little
Yeah.
more reputable, but actually Yahoo Finance is pretty good.
Okay.
So they do great work. And then a lot of the stuff that I keep up on is industry designed for advisors like me. So there's different series, different thought leaders in our industry that help to share, hey, here's 10 charts that help explain what's going on in this geopolitical issue or this time,
Mhm,
or
mhm.
those kind of things that are really helpful for my own perspective. And then I get to translate it to English for my clients. So,
I'm so glad you like that. I mean, I start going,
yeah.
start blinking and twitching and thinking, no, I don't understand this, and I don't want to.
Yeah.
I
Yeah.
think, and I think for most people, if you haven't had the training, if you haven't had the experience, if you don't have the backup, and the resources to help you know what to do, it's really easy to make a big mistake.
Yeah, and I don't change my own oil, right? Like I don't want
Right.
to I could change my own oil, but I don't, right? And it's the same
Yeah,
thing. Like
yeah,
my
yeah,
many of my clients, they could if they were interested and really wanted
yeah,
to do some of the deep dive on
yeah.
this, but most people say I'd rather be out enjoying my life. And that's part of that partnership too. Yeah.
Yeah, that's good. I don't change my own oil either.
Yeah.
Um, okay, so is there anything here I haven't asked you? Um, well, okay, the last question is, because I have been here personally, is what would you say to someone who feels nervous about the markets after everything that they've been through?
Yeah.
So you mean they've been through this big loss, they've been through this big transition themselves. Our country goes through certain transitions, and how do you help people um, feel safe?
Yeah.
And I think this is the important thing as we go forward and we go forward solo.
Yeah.
How do we feel safe? How do we know that we're making good decisions?
Yeah. I think the focus on what the right thing to do is
Hmm.
should always be on your unique picture,
Hmm.
on your needs, on your lifestyle, on your plan, the
Hmm.
financial plan. Because once we start to look out and try to predict what's going to happen here or there or here, we are doomed from the start.
That's right.
And the thing that's really crazy about investments is that in the time where things are going very well, we feel like we don't need to do anything.
Hmm.
And when the times when things are really bad, we feel like we should do something. And
Yes.
it's the opposite.
And it's the opposite.
When
Okay.
things are going well, that's the time to say, all right, is it time to raise a little bit of cash from our investments to for the next year or so, or for an upcoming remodel or whatever we want to do? And in the times where it's not going so well, just like we talked about,
Hmm.
not pulling out at the dip
Right.
because
Right.
you miss the recovery. So
Right.
I guess acknowledging just the dissonance that general investments and
Hmm.
that strategy brings in us is one piece of this. And
Hmm.
coming back to your own plan and your own
Hmm.
needs is important.
Yeah, I think that's important. And again, having somebody you trust, somebody who knows that has your best interest at heart.
Yep.
I think that's incredibly important information. So once again, thank you.
Thank you.
This has been a great session, and we were going to continue this series. And I'm just so appreciative of your expertise and your time and sharing your knowledge with us. And we'll see you soon. So thank you.
Great. Thank you.